Welcome back to Smart Stock Sam, the channel where we cut through the noise and give you the data that actually matters. Today, we are going in deep on AMC Entertainment. Is there a real rebound hiding in this chart? Could earnings next week flip the script on what looks like a total financial collapse? And what is a realistic price target heading into next week? We are going to answer all of that, with the full valuation breakdown, the momentum indicators, and a clear trade setup, right now. Let's start with the brutal truth. AMC has officially hit a price point that erases every last trace of the meme-era premium. As of this week, shares are sitting at $1.20, just off a new 52-week low of $1.19. And here is the thing, the stock price is not even the real problem. The real problem is buried in the numbers underneath it, and those numbers are telling a story that most retail investors do not want to hear. The Altman Z-Score, which is the gold standard model for measuring bankruptcy probability, currently sits at -1.1. Let that sink in for a second. Anything below 1.8 puts a company in the official distress zone. AMC is not just in the zone, it is deep below it, and it is not alone down there. Major institutional players like Pentwater Capital have already seen enough. They did not trim their position. They did not reduce exposure. On February 17, 2026, they reported 0% beneficial ownership. They were gone, completely out. When firms that size sprint for the exits, they are not doing it on a hunch. They are doing it because they have seen the debt structure up close. Now, let us talk about the chart, because the visual alone should stop you cold. AMC has declined 66.6% year over year. This is not volatility. This is not a correction. This is a sustained 12-month destruction of valuation premium. The market is repricing AMC for a completely different and far darkerish reality than the one Reddit sold you in 2021. But here is where it gets interesting, because if you look at the price-to-sales ratio in isolation, AMC looks absurdly cheap at 0.11, a 5-year low. You might think, wait, am I buying revenue at a massive discount? And the answer is yes, technically. But that is only half the equation. The other half is the EV-to-EBITDA, sitting at 45.21. That number tells you the market is deeply skeptical that AMC can ever turn that revenue into actual earnings. You are not getting a bargain. You are getting a trap dressed up as a bargain. And as the model deteriorates, so does the company's standing in the market itself. AMC has officially dropped into small cap territory, market cap hovering between $626 million and $649 million. That is a critical threshold. When stocks fall into this range, the large institutional funds that provided stability quietly walk away, leaving the stock exposed to extreme volatility and aggressive short sellers. Speaking of institutions, let us look at who is actually left. Vanguard is still holding 50.1 million shares. UBS is holding 23.2 million. But do not get too excited. Most of this is passive index ownership. They hold it because they have to. Active management interest is showing signs of extreme fatigue. Total institutional ownership is estimated somewhere between 28.8% and 48%, and the trend is clearly moving in one direction, down. The smart money is thinning out right as AMC approaches its most dangerous financial hurdle. And that hurdle has a number attached to it, $2.5 billion. AMC is currently marketing a refinancing package that includes a $750 million term loan and $1.73 billion in secured debt to cover maturities coming due in 2026 and 2029. This is pure survival mode. They are not thinking about growth. They are not thinking about shareholder returns. They are thinking about keeping the lights on. And when a company is in that mode, you, the shareholder, are last in line. To raise cash while doing all of this, AMC is running an at-the-market offering worth up to $150 million. What does that mean? It means they are printing new shares and selling them into the open market. Every share they sell dilutes the value of every share you hold. This is not a growth strategy. This is a company selling pieces of its future to pay for its past, and with a debt-to-equity ratio of -4.61, the math here is statistically terrifying. We are not talking about a company that is struggling. We are talking about a company with meaningful bankruptcy risk within the next 24 months. So, does any of this matter if earnings next week surprise to the upside? Let us look at what the technical indicators are actually saying. AMC is trading significantly below both its 50-day and 200-day moving averages. In technical analysis, that is a no-fly zone for professional traders. We are in a deeply entrenched downtrend. However, and here is where it gets spicy, the 14-day RSI is sitting at 32.33. That is approaching oversold territory. When RSI gets this low, we historically see a dead cat bounce, a temporary relief rally, but the MACD is still negative at 0.016 below the signal line. That means there is zero organic buying pressure confirmed yet. It is like watching a falling knife slow down, but it has not hit the floor. Could a short squeeze accelerate that bounce? Short interest is sitting at 24.44% of the float. That is 124.87 million shares held short with a days to cover of 3.85. The ingredients are technically there, but, and this is the critical part, the borrow fee is only 0.68%. That means it is extremely cheap for shorts to hold their positions. They are not trapped. They have no urgency to cover unless a major catalyst forces their hand. And the options market is telling us exactly what traders think that catalyst could look like. For the February 27th expiry, we are seeing a massive tug of war. Speculators are loading up on calls at the $1.50 strike, essentially buying lottery tickets on an earnings moonshot. On the other side, heavy put concentration at the $1 strike says a lot of money is betting this thing falls to $1. There is no middle ground in this options chain. The market is pricing in a binary event. Either AMC squeezes 25% or it cracks to $1. Pure volatility, pure speculation. Before I give you my analysis on next week's trading setup, please remember, nothing in this video is financial advice. Smart Stock. SAM is an educational and informational channel. Always do your own research before making any investment decisions. Consult a licensed financial advisor if needed. Investing involves risk, including the potential loss of principal. AMC is a high-risk, speculative security and should be treated as such. So what is the actual verdict? Here it is. For long-term investors, avoid. The combination of financial distress, a deeply negative Z-score, ongoing dilution, and a $2.5 billion debt wall makes this a gamble, not an investment. But for short-term speculators with iron nerves, the February 24th earnings report is your catalyst window. Do not enter early. Wait for a confirmed breakout above $1.26 on high volume. If that confirmation comes, the target is the $1.50 call wall. And you must, absolutely must, keep a tight stop loss below $1.15. One breach of that floor and you walk away. The ape spirit is real. The community is real, but right now, the math is louder than the memes. Trade with extreme caution. If this breakdown helped you see AMC differently, drop a like, subscribe to Smart Stock Sam, and I will see you in the next one.